When your name couldn't open doors, you didn't give up. You made your way in anyway, only to find out that there are many doors you still need to open. So you work hard to get the keys until your name began to open doors.
Let Meristem help you keep the doors open for generations to come. Meristem, let's grow wealth for you.
You're welcome to today's webinar brought to you by Meristem Registrars and Probate Services Limited, a subsidiary of Meristem Securities Limited. Let's look at this webinar this way. Imagine you have planned out a road trip, you have your destination in mind and your estimated time of arrival, only to begin the journey and then begin to experience unexpected challenges, a few detours here and there, twists and turns, and then in the Nigerian context, a few potholes, right? That's how some people view the regulatory landscape in the Nigerian capital markets, and that's why we're here. Our webinar, Partnering for Growth, Addressing Key Regulatory Issues and Future Direction, has been set up to help us make sense of these changes and prepare for what lies ahead. Today in the house, we have 4 esteemed panelists from the NGX, from SEC, we have a tax consultant, and we have someone from the FRCN. Our panelists will be shedding light on 4 major areas. Number 1, the latest regulatory updates and their impact on businesses and investors. Secondly, they will be speaking to smart compliance strategies to stay ahead and build investor confidence. Thirdly, trends in corporate governance and financial reporting. And finally, they will be giving us insights into the future of the capital market and what it means for all of us. At Meristem, we strongly believe that growth happens when we stay informed, collaborate, and adapt to changing circumstances. So please, let's make the most of today's webinar. Let's engage. Let's ask questions. We have these regulators with us here in-house to attend to all gray areas and shed light on every issue that is on our minds. I'll proceed to introduce our guest speakers here with us. Firstly, I have with us the CEO of NGX Regulation, Mr. Olufemi Shobanjo. Thank you so much for making it down here with us today. Mr. Olufemi Shobanjo has over 20 years of experience in corporate and commercial law, compliance, regulation, banking, and financial markets. He brings deep expertise in capital market oversight. Prior to leading NGX Regco, he led the broker-dealer regulation department at the Nigerian Stock Exchange, overseeing over 250 stockbroking firms. We are glad you are here with us today. And then I must give you a feedback. So we had sent out surveys asking people to send in their questions and gray areas they needed us to shed light on. And most people said NGX is the most friendly of all regulators, that they actually work hand in hand with you to achieve your goals, as it doesn't look like they are working against you. So thank you very much to you and to the NGX Regco. Secondly, we have here Mr. Stanley Aniaboso, Principal Manager, Directorate of Inspection and Monitoring, Financial Reporting Council of Nigeria, the famous FRCN. He specializes in corporate reporting compliance, analyzing financial statements to ensure adherence to accounting standards, and recommending regulatory actions where necessary. Unfortunately, Mr. Stanley couldn't make it down here physically as he had an official appointment outside Lagos, but he is with us here online. So please, we encourage our online guests to please give him an ear applause in the chat box. We also have with us here, permit me to say the almighty sake, Mrs. Kelechi Azubike, a seasoned professional with vast experience in finance, technology, and regulatory oversight. Having built a solid career at the Securities and Exchange Commission, her expertise spans market operations, regulation, and compliance, making her a key voice in financial sector governance. You're welcome, Mr. Azubike. And finally, our seasoned tax consultant, Mr. Adeyemi Afolabi Smith, Senior Manager, Creston Pedabo Professional Services. He is a tax and compliance expert with over 14 years of experience. He is a fellow of ICANN, a certified management consultant, and a member of the Institute of Directors in the UK. I must say that these are just a few out of his many certifications. There are quite a lot. He's here to provide valuable insights on tax-related regulatory matters. Thank you for joining us, Mr. Afolabi. And I remain your moderator for today. My name is Nkechi Nyelokoye, COO Meristem Registrars and Probate Services Limited. Thank you very much. With that, let's dive into today's conversation. And I'll be starting with you, Mr. Femi. So most times, like the feedback, what gave birth to this webinar is complaints most times from public listed companies, from investors. You just say, oh, regulator this, regulator that, this regulation, this has changed. And a lot of people keep complaining. Is it possible that we see regulators as partners? Well, are they really our partners? Or is it just the proverbial adage of the police is your friend? Are regulators really our partners? And if they are, how can we work hand in hand with them to ensure that our businesses reach the destination that we have had in mind? I would like you to share more. Thank you.
All right, thank you very much. Good morning, distinguished ladies and gentlemen. It's a pleasure for me to be here. I thank the organizers, Meristem, Registrars, and Probate Services Limited, for putting this wonderful event together. I'm sure that we will find this session very, very engaging and insightful. So going straight into the question that I was asked, which is around our regulators, partners, in progress as it were. And I think for us at the NGX group, and indeed at NGX regulation, that is exactly how we see ourselves. I'm glad to hear the feedback from the survey that was given to say that NGX is indeed a very friendly regulator. Because you have to understand that the objective of regulation is really to maintain the integrity of the market. Okay? So I think if we start from that lens, you will find that we are working together towards maintaining that integrity. And without maintaining that integrity, you don't have any confidence in the market, right? The absence of confidence, then there will be no market. Investors will not. We've seen what happened locally. If you look at what happened in 2007, 2008, financial crisis, which obviously, as you know, was a global event, we saw what happened very quickly, even in the local markets, where investors took flight. And that led to a lot of uncertainty, and that just led to chaos in the market. And so clearly, regulators and investors and all stakeholders indeed have to work together in very close partnership. And that is exactly how we see ourselves. So I've spoken about integrity of the markets, I've spoken about confidence of the market. I think that even in terms of building and developing the market, we have to understand that the regulator's role also involves growing the market as well. And so you can only do that with the support of the stakeholders that are regulated. And it means that you have to get their respect and their trust. All right, they have to believe in what you're doing to actually grow the market. So if you look at it from our perspective at NGX, when we want to develop new rules in the market, one of the ways you develop rules because perhaps there are gaps in the market, because there are problem areas, or the market needs to evolve. The way you develop rules is that because you don't have all the answers. Okay, you can't pretend that you have all the answers. You have to engage with the stakeholders. These are the problems I'm seeing. These are the areas this is how I think we can fix them. What are your thoughts? So when you develop rules, you expose them to the market participants to also get their own thoughts and ideas before you then finalize and implement it. So it's a two-way thing. It's a very closely close relationship. The partnership has to be very strong and has to be maintained in order to grow the market. Then, of course, we should also understand that we're also in a digital age. All right, technology is really growing at an alarming rate. It is disrupting financial services across the world, right? And so that also has to come into play. There's no point if operators are moving in one direction, regulators are moving in another direction. Everybody has to sort of align. And we know that innovation will always come first. That is the aim of the game, right? No matter whether we like it or not. Innovation will always come first. And so the regulators have to find a way to catch up or to adapt. And I think technology has a way of bringing that together. Throughout the course of this conversation, I'll talk a little bit more about some of the technology, digital initiatives, and digital transformation.
We also have questions
on
that.
I can imagine. But I think this just sets the backdrop around, look, you cannot see a regulator as someone that is just creating hurdles and obstacles and fighting. Because it wouldn't really help. I have to admit though, that perhaps there may be some regulators that have that style of operating, that they just do the rules for you and their daily fines waiting for you. Whenever you're ready, come to me, I will just give you your bill. I'm happy with that. But I think that as we're in 2025, as the world evolves and as markets evolve, as financial services and other industries continue to grow, you will find that that is an approach that regulators are shifting away from very, very quickly, because they also have a role to maintain, like I said, integrity, but also to grow the industry in which they're regulating. If you're not growing the industry in which you're regulating, then you're not really doing a great job as a regulator. And so the operators have to get the buy-in that these regulators know what they're doing. And we have faith and we have trust and confidence in what they're doing. And then you can work very closely together in building that relationship. I think I'll pause.
Thank you very much. You said something very profound at the beginning. You said regulators are here to protect the integrity of the market. And when there's no integrity, there's no market. Build market. Thank you very much for that particular statement. In light of what you just said now, yes, some regulators are builders. They're just here to find you. I'll move on to you. This is Asibike from SEC. Someone asked, we've seen increasing calls for regulatory flexibility to support business growth. How does SEC balance the need for regulation with fostering a business-friendly environment that encourages innovation and attracts investment? If I'm to speak another feedback, just to give you word for word, someone said it appears, SEC appears like they're just here to impose fines for non-compliance, and the fines are actually on the very high side, with little or no possibility of negotiation or reduction for whatsoever. So please, do you want to speak? Do you need to speak again?
No, I got most of it. So thank you very much, Kiji, and it's indeed a pleasure to be here. Good morning, good afternoon to everyone listening from wherever you're listening. I'd like to thank the DG for the nomination because of his support, I'm here to speak on behalf of the Commission. Now, your question spoke to flexibility of the regulator and imposing of fines. Okay, so I'll start with speaking about the business environment and the flexibility of the regulator. So now the SEC is moving away from what you see as a rigid regulator to one that is more flexible, because we see that the environment is changing and we need to change with it. So some of the things we've done in this area to make businesses easier for people to even venture into, make our regulations easier for them to understand. So looking at innovation, we used to have a fintech and innovation office as a division. But because we see that this area is growing, it's a budding area, there's a lot of interest in that area, we expanded it to become a department. So we now have a fintech and innovation office, which is a full-fledged department. And we also empowered that department. We have a strategy division that also looks at strategy for businesses that are willing to innovate. Now, in order to also help those businesses grow and to innovate, we introduced the regulatory incubation program. So there's an accelerated version and a regular one. So we call it the RIP and the RIP. So to encourage innovation.
Regulatory
incubation program. Yeah, so this is where we're looking at fintech businesses come into a sandbox system. You test out the business for a while, then we give you a provisional license. Okay, operate for a bit before you now take it into the full-blown environment, and then we give you a registration. So we use this medium to allow businesses to innovate so that we can look at what you're doing and see if it falls within the confines of the SEC. So that's one way we ensure that there's flexibility in what we're doing. Our rulemaking process is almost similar to what Mr. Shomajo had explained earlier. So it's a flexible process. We have a rules committee that meets regularly from time to time to review rules. We look at the market, we look at what people are saying, we receive feedback on these rules, we expose them, have public comments, then we expose when we're finalized with them. So it's an all-inclusive process, just similar to what the NGX is also doing. And it will interest you to note that in terms of enabling the business environment, there was an action plan by PEBEC, that's the Presidential Enabling Business Committee, Council, sorry. And it will surprise you to know, sometimes we don't blow up trumpets enough.
I was about to say, because even the regulatory incubation program, I'm not sure most people know about.
No, it's very open. So we have it on our website. We have people apply for a period of time, and then we close the application because we need to review them. It's not open, yes, it's not open forever. So there's a timeline, it's open. People apply, we take in those applications, review them, and then give feedback based on those reviews. So we take in another set. So we're doing it exactly. So we're doing it in bits. So speaking to not blowing our trumpets, out of the 6 NDAs that were reviewed, SEC was actually one of the NDAs that met with the KPI in terms of enabling the business environment. So it's surprising to hear that because we don't blow our trumpets enough. Now, speaking to the area of penalties, speaking to you saying that penalties are on the high side, we always seem like we just want to penalize.
Negotiation,
or reduction in fees. So I would say from my view, I've heard a different opinion though, that our penalties are not punitive enough.
Wow.
So I won't disclose it. So it depends on the side of the coin you're looking at it from. So this is about perspective. So whose perspective are we looking at the end of the day?
Okay.
So at this point, our interest is to get you to that point of compliance where we do not need to penalize. So we'd like to work with the operators, with the public, to get you to that place of compliance. If you need us to empower you in terms of training programs, we have those we can organize for them. So we want to get companies to the state of compliance where we do not have to run after you, where we do not have to fine you, we do not have to penalize you. I mean, if there's market without penalties, it would be a wonderful place to actually be. And then investors will be very confident that the market is actually doing well. I mean, you're not penalizing anybody. They won't see it in the AFS. So I would stop there. And if there are other questions, I can take it after that.
Okay, thank you. Thank you, Vanessa. Do you want to add something?
No, I think she's covered it quite broadly. I think if I just add, I think that perhaps the point she made around the regulatory sandbox is a very innovative solution that the SEC is doing, and perhaps it's not spoken widely enough, and perhaps we should do more in promoting that. The SEC is doing what a lot of other leading jurisdictions like the UK and a few others are doing, and you will find that some of the new areas around maybe digital assets and crypto exchanges, they've come from that space where they're in regulatory incubatory or this sandbox where the SEC is giving them a lot of support for them to do their innovations in a very controlled manner before they then expose them to the public. So I think it's a wonderful initiative by the SEC.
Okay, sorry. Before I come to you, there's a very interesting question I see here. I think this person, Mr. Chuks one day, is speaking to innovation, right? It's directed at you. Except all these investment instruments that the Nigerian platforms offer, none offer more than one way to trade with them, meaning that like everyone is probably doing the same thing. With all these regulations at play, why is there not anything to address these issues to increase retailer participation in this sector? So I think it's asking about innovative ideas. What is NGX doing to increase retailer participation and diverse ways of doing things in the market?
Great question, actually. Mr. Chuks, you said?
Yes.
Yeah, Mr. Chuks, I think that is really at the heart of what the NGX is trying to do. Alongside the SEC and other major stakeholders, is really to deepen retail penetration. I think it will interest you to note, I think there was a study done about 2 years ago that in our market, in 1 year, in a whole year, you had only about 100,000 unique investors trade in the market in a population of over 200 million. And so one of the things you will see in the SEC's master plan is that we have to grow the investor base to around 5 million, something like that. So coming from a very low base of 100,000, clearly Mr. Chuks is in the right direction in terms of we need to innovate, bring in more products. Clearly around cryptocurrency around the world, you find that Nigeria is one of the big markets. Yeah, you have a lot of young investors going into that space. It's even with all the risk and volatility that you see in that market, you see a lot of other people going in there. You see it around the FX markets, all these online retail. So the exchanges have to certainly innovate to bring in products and other platforms that young retailers can participate in. One of the things we've seen over the last few years is that with the instability in the foreign exchange market, we have more stability now, but we've seen a lot of young investors flock towards foreign exchanges, foreign equities. So some fintechs have come out where they're providing you platforms where you can actually go the other way, invest in these foreign equities. And so there are a number of things we're looking at things like what you call NDR, non-depository receipts, or Nigerian depository receipts, where it can expose you to foreign exchange. We're looking at digital assets. The SEC has put out rules around that. There's a framework that is going through the procedures at the moment. That also helps us. I think one thing that has come out recently over the last few days is that there's been approval for the new Investment and Securities Act 2025. Really, that really opens a new vista of opportunities for the capital markets, for the SEC, for the exchanges, and for market operators to really come together and innovate. It brings the capital markets in tune with the current realities that we see around the world today. And I think that a lot of work will be done, certainly, as we progress. And I think that technology is really at the heart of driving a lot of these innovations. So watch this space, Trooks. You would see a number of products rolling out that would attract young minds like yourself.
Thank you. We really look forward to that. Thank you so much. Mr. Stanley Anyaboso, please confirm that you can hear us.
Yes, I can hear you very well.
Thank you very much. Thank you for joining us. All right. So for FRCN, we had a question sent in. What are the most common financial reporting deficiencies identified by FRCN, and how can companies mitigate these risks proactively? So the person that sent in this question doesn't want FRCN to spring up any surprises on them, and they're asking ahead of your monitoring and inspection exercise, what are the most common deficiencies that FRCN has identified, and how can companies mitigate these risks proactively? Thank you.
Okay, thank you very much for that question, and thank you for the invitation to be part of this webinar. So there are a lot of things that can go on in financial reporting. But before I go on, I think it's important that I make this point that one thing we have observed in financial reporting generally, starting from when we adopted the IFRS, is that we have seen significant improvement in disclosures in terms of what reporting entities report in their financial statements. So over time, some of the non-compliance issues we have been able to pick up during our review of those financial statements have significantly dropped. And for us, it's a plus for us because that aligns with our mandates to ensure that there is credibility in the financial reporting space. And as we go on to have these credible financial statements, is what the Financial Reporting Council is set out to do. But that doesn't mean that there are not a few other non-compliance issues that we also observe. So basically, in the Financial Reporting Council, there are two levels of non-compliance issues. We categorize this non-compliance into two. We have the regulatory issues. So these are issues that deal with non-compliance with rules, regulations, and laws that are made for credibility of the financial reporting process. So rules like the Companies and Allied Matters Act, the Financial Reporting Council's rules. The council has a lot of rules that are set up to enforce financial reporting. So when we see non-compliance with those rules, we term them as non-regulatory issues. So we also have the other bucket of non-compliance issues that are known as the accounting issues. So these accounting issues are issues that have to do with non-compliance with the provisions of extant financial reporting standards are in place. So the financial reporting standards could be the IFRS accounting standard. It could be the IFSAS for entities that operate within the public sector space. It could be the IFRS for SMEs or any other international standards that is adopted by the council. From the regulatory point of view, non-compliance can occur when you don't comply with the provisions of the FRC Act.
Okay. Thank you, Mr. Anyaboso.
Time. Hello, can you hear me?
Yes, we lost you for a bit, but we can hear you now.
Okay, so on the non-compliance issue,
Okay.
issues. So we have things like non-compliance, a lot of rules, about 14 rules now. So when you don't comply, that stipulates that at any point in time, the chief executive officer and the chief financial officer must certify those financial statements, and they will certify that by also disclosing their FRS registration number. So we've seen a lot of entities that don't do this correctly. So those ones are categorized as CG 2018, the National Code of Corporate Governance code. Okay, where we'll see entities with inadequate board size. We'll see also entities not complying with the provisions of the statutory audit committees in terms of at least one of the members of the audit committee being a professional accountant, and of course, adhering to the composition of the committee as stipulated in CAMA. Okay, and of course, when we also come to accounting issues, we categorize these issues depending on the severity of these issues, because not all accounting issues are of the same significance. Okay, so there are issues that, when they happen, will require the entity to withdraw the financial statement, and we'll categorize these infractions as type 6 non-compliance issues. So when you have issues like where a reporting entity is preparing a financial statement using a financial reporting framework that is not enforced within the jurisdiction, okay? When you have entities still preparing their financial statement using, for instance, the statement of accounting standard that has been replaced with the IFRS, or when you see entities not presenting a principal component of the financial statement. Maybe in your financial statements, you did not present your statement of financial position or statement of comprehensive income or any other component of that financial statement. Okay, so when these infractions occur, we usually ask the entity to withdraw the financial statement, and the withdrawal procedures are outlined in section 60 and 61 of the FRS. So there are also other non-compliance issues that deal with policies. Okay, we've seen entities that have accounting transactions, but they did not specify a policy that drives those transactions, or the policy is inadequate, okay, or when there is insufficient disclosures as to the exposures that the entity is exposed to. So all of these are some of the non-compliance things that can occur. So if I find time, I can still speak more on that. Thank you.
Thank you very much for your profound answer. I heard you do you want to ask that?
I was just agreeing with some of the comments. When there should be a financial, especially pick out specific flag them out and then send it back to you. If you don't have the statement of financial position, for example, stated properly, definitely flag that out. And of course, at the end of the day, nobody wants to care about penalties. So we expect that everything is done properly. Signatures signed, the proper signatures actually signed the local accounts before they're submitted to this.
Thank you very much. Speaking about risk, we'll come to Mr. Afolabi. What are the key tax risks that capital market operators face during FIRS tax audit? And if I were to add to that, how can tax policies be used more effectively to stimulate the growth of Nigeria's capital markets? And this person also wants to know, are there any successful models from other countries that Nigeria should consider adopting?
Okay, thank you. Thank you for having me. I'll stand on the existing protocols. When you talk about key risk in terms of FIRS tax audit, the capital market operators are just like every other company in the country, right? And some of the peculiarities with the capital market has, a bit of, direction away from what the conventional companies, would experience. But generally, talking about risk, two key things that drives, the tax authorities, the tax audit exercise has to do with revenue and then expenses. The tax authority is interested in you fully disclosing your income from all avenues worldwide, right? And they're also interested in you not overstating your expenses, such that at the end of the day, you have profit that is robust enough, for them to take their own, share, being a stakeholder in the business, of course, at the effective tax rate. In terms of having to account for those revenue and the expenses, a lot of times a lot of CMOs are having issues with proper, adequate documentation. You have instances where you have reported certain transactions in separate manner, in certain manner, right? And at the point where the tax authority is around, for them, where there are no documentations, those transactions don't exist, right? So
You have instances where people do not keep adequate documentation. So it then leads to having to come up with robust explanation as to why this is treated this way without providing a compensating, documentation. And that is really eating companies big time, because they are now having to part away with tax liability, with interest and penalty for inadequate documentation. Those are some of the things. Another perspective is the fact that the way these organizations are being structured, right? A lot of times, the tax authority has the mind or the mindset of wanting to get as much tax liabilities from an entity as possible. And so most times, some of this key risk that also comes out during tax audit has to do with the inappropriate classification of certain items. The capital market, for instance, has strict regulations, has some complexities that have to be categorized in certain manners. But for the purpose of reporting, it could be oversight, it could be any other reason. The way some of those things have been classified to the tax authority, there's no other reason why they should not subject those kind of transactions to tax. And so they are as open-minded, as closed-minded, as wanting to, take advantage of the situation as much as possible. Talking about the tax advantages that, tax incentives and the advantages. Currently, Nigeria is, rolling out different tax policies to hit businesses in the capital market. You talk about the REIT, talk about the bonds, we'll go to all of that, and the ETFs and all of that. But significantly, tax incentives drives a lot of business growth in every country. The capital market is a very sensitive one, right? For you to drive growth, you need to put in as much capital, as much tax incentives as possible. Because when you put in a lot of incentives, it then drives the mind of investors and whet their appetite to actually want to do more. Take, for instance, in Singapore, right? Singapore has a tax system where, as a non-resident investor, when you earn interest by virtue of your investment in the capital market, it is not liable to taxes. So what that does is that it encourages a lot of FDI, people bring in money. Of course, there are conditions. It's also been structured such that you don't use money within my zone, do businesses within my zone, and then invest that same fund into my zone, and then want to get tax exemption. It has strict regulations as to the funds from which you're investing must not be in Singapore. It must be coming from outside, so that as much as possible, you are encouraging people to bring in funds. And, it also has some capital thresholds, right? In terms of having to put in to say, if you're investing $2 million to this level, these are the incentives that you get. What that does is I'm interested to take to Singapore as much funds as I have, right? Because I want to take a tax advantage and invest in the local economy. Also talking about some of this incentive, for instance, in the UK, they do the real estate investment trust scheme just like we do. But in the UK, for instance, when you earn income as a real estate investment trust company, you earn an income from rent and from sale of investment property or from sale of property, you get to be exempted, from taxes. And then even when you're redistributing that dividend, whatever you get, redistributing to the investors or the unit holders, you don't get to withhold taxes. Unlike the Nigerian climate, yes, with our current regulation at the current dispensation that we have, talking about the real estate investment trust scheme, there are certain conditions that will actually give you a tax exemption. For instance, the income would come from rental income and dividend income. The REIT, the intention of having to introduce that REIT in the very first place was because government was also looking at how to boost the capital market while also enhancing the real estate. You would agree with me that in Africa and Nigeria, for instance, we have deficiency of house, right? We have house deficiencies. And it's just a way to cushion for those impacts so that people are encouraged to bring in funds. Now, what is applicable under REIT in Nigeria is the fact that when you make investment, right, when that those dividends are being redistributed to the shareholders or the unit holders, the REIT earning that rental income and dividends, as long as they redistribute 75% of what they make to the shareholders, then they get a tax exemption. So to the extent of what you distribute, you are exposed to the remaining that you do not redistribute. What that does is that it stimulates the mind of the investors to say, after all, I'm going to get as much return as possible, right? And then people want to put in more funds to actually take advantage of that. So on a general scale, some of these schemes has been, implemented in other countries, can actually be replicated here. I know it's a matter of time, we'll get there. Nigeria has, some, special dispensation that would, people want to take caution in terms of investment, but as more tax incentive as you roll out as possible. You would agree with me that the level where we are now, we need a lot of foreign direct investment. And how do you get there? You need to make sure that the major things in terms of security, the infrastructure, they are rightly in place, such that as an investor, I can move funds from anywhere in the world because I'm certain of your infrastructural pattern, and I'm sure that my investment will not be eroded and be lost, like he said, like Mr. Shubhani said. The way the market has evolved over time, you've seen significant growth, right? And people also want to put their funds where they are sure that, they would get their return and it will not really fluctuate. We have stability now with our foreign exchange, so, things are beginning to stabilize. So I'll stop at that for now.
Thank you very much. I'm back to you, Mr. Shobhanjo, but please, before we continue, I would like to encourage us, to our viewers online, to please drop your questions in the Q&A box. We also have a team of professionals online who will also be answering your questions, as many as we are able to take live. Thank you very much. So I'll be coming to you, Mr. Shobhanjo. The next question for you says this: many organizations cite stringent listing and ongoing disclosure requirements as significant financial and administrative burdens. Are there any planned measures to simplify these processes, particularly for SMEs?
I think it's a very, very relevant question in today's environment. We get those sorts of inquiries. And indeed, a lot of work is going on in that regard. The perception is that listing is very expensive and there is a massive or a heavy regulatory burden in being listed. And perhaps there is a school of thought that agrees with that thinking, and there's a school of thought that is against it. But I think what we are trying to do at the NGX is we are really trying to simplify the listing process, the listing requirements. We know that today we have private markets that are thriving. Around the time of COVID-19, you saw a real emergence of, would I call it an acceleration of digitization, right? So these things were happening, but we really accelerated during all that lockdown time. And you are seeing a massive wave of companies here, startups, that are raising funds internationally in huge amounts. And that is growing. I think Nigeria is one of the biggest destinations in Africa, right? So it's clear that that market already exists. And so what is the value proposition of being listed if you can do that same thing offline, let me put it that way. So a lot of thinking is going into that. We've done a global study and we're starting to simplify the process of being listed. Perhaps what worked 10, 20 years ago may not necessarily be relevant today. The essence of regulation, as we had said earlier, is really to make sure that there's investor protection, there's transparency, accountability, and make sure that the system, there's integrity, right? Can we do those things without having some of those things? So we're already trying to reduce the burden. So I'll tell you some of the things we've already done. The cost of being listed annually, we've already introduced a tiering system so that it's not a one-size-fits-all. So that the big company and the small company are not paying the same thing. It's based on your size and complexity and capacity and all of that. So I think that spreads the burden a little bit. Then two, around just looking at the rules, around what are the things that we can easily tweak to just make it a bit more appealing for some of these other companies. Now, we have what they call a technology board, which we introduced a few years ago. This is really targeted at the fintechs, the startups, and all those types of firms. The regulatory burden or requirements in that space is much less stringent than you will find maybe on the main board or the premium board. So that already exists today. That makes it a lot easier for those types of companies to come in there. We also have what we call the growth board, right? Again, it's for
companies that we perceive to be fast-growing SME type companies that would even have the ability of working with professional advisors at a more limited cost, right, than your traditional professional advisors, like our gentleman here and others. But essentially, what that does is that it really tries to attract, these young, fast-growing companies, amongst a number of other things that we're looking to do. Because of time, I won't go into too much detail, but that just gives you insights into the thinking. Expect to see a lot more happen in the coming weeks and months ahead, because I think this is one area that we're really trying to attack from all angles. Thank you.
Thank you very much. Whilst you were speaking, there's a question in the chat box, but I don't think you can speak to the FIR. But I was just wondering, all these models and examples that you have set, are there platforms and forums where tax consultants have conversations with the FIRs, LIRs, to discuss some of these initiatives and how we can implement it in Nigeria? Is there a forum like that? I'm just being curious.
Yes, there are.
Okay.
Of course, there are time to time where there are some sort of stakeholder engagements that are being put up by the tax authorities, to disseminate information, to do proper guidance, to make sure that investors or taxpayers are aware of certain things. But in terms of the frequency, maybe not as frequent as expected, right? I think we can also do better in that part. I know a lot of times, even some professionals come together to do some sort of webinar in their district and zones, but it should be more consistent in terms of creating awareness, educating the public, the taxpayers, the investors. It should be more frequent. So I agree. But the thing is that currently there are different scales on which those conversations are being held. But in terms of the consistency, maybe not as pronounced as expected, but we hope to get there someday.
Still on tax, I'm a Nigerian investor. What tax considerations should I be aware of when looking to invest, especially with regards to capital gains tax?
Okay, capital gains tax. Some taxes are actually inevitable depending on who the investor is, right? If you are the corporate entity, you are probably looking at capital gains tax, and if the investment relates to assets, digital assets, stock market, and all of that. Or if it's relating to any individuals, for instance, then of course you talk about your personal income tax, which is applicable. Or CGT is more common, right? And I don't know if, to call this, it's a development. Whether good or bad, it is a development. Currently, in a couple of months, right, there's going to be a different shift in the entire tax terrain of the country. Currently, there are conversations ongoing as to the Nigerian tax bill, right? And currently now, a stakeholder is worried about having liabilities on capital gains tax. There are triggers for all of those taxes depending on what you invested, right? Before now, for instance, you would be more concerned with, what kind of security do I invest in to get exemption, right? Yeah. But now, since 2022, the exemption has, the sun has set on that, and everyone is in the regular space. But the capital gains tax now is not just being triggered because you're doing transactions in the capital market. There's now a threshold, right? Which means that you actually need to exceed a disposal proceed of 100 million naira, which means that you're still doing business in the range of 50, 35, still trying to encourage you to put in as more funds as possible. And then the moment you scale above 100 million, that it means that you should be worried of capital gains tax, except when you now decide to reinvest that proceed in the Nigerian capital market. What that also does is that such that even when people try to be liquid with finance, they also look at, okay, how do I get a tax advantage? Let me plow back the money into the capital market. And what that does is it keeps expanding that base. But in terms of individuals, for instance, when I said that the game is about to change, Currently now the tax rate for capital gains tax is 10%. In the next couple of months, if the Nigerian tax bill scales through, there's not going to be anything like capital gains tax. It's now being consolidated to the Nigerian tax bill, which means that you're now liable to tax of 30%, right, instead of the 10%. But then again, there comes the ability to have to keep proper documentation of all your costs in terms of the fees you pay to professionals, the listing fee, every other fee, apart from the cost of acquiring that asset, would be considered to arrive at what would be your gain that would be taxable. Interestingly, because government has now increased the tax threshold to say that it's now going to be at 30%, there's nothing like capital gains tax anymore. You're going to pay 30% corporate taxes, especially when you are any other company as defined by these regulations, right? So what that means is that you get to pay 30% corporate tax, and then you get to pay 4% development levy that would also be collected, and that ends the transaction. So what's on a summarized scale, it simply means that way forward, there's going to be a need to actually seek guidance, right? Be sure you can't just invest with sentiment, right? As an investor, you need to be very strategic in terms of your investment, having proper guidance, and making sure that you take as much advantage as possible. Yeah.
Thank you very much. There seems to be a lot of questions for NGX and for the tax force workers. There's a question in the chat box from Mr. Shobola Shotupo for you, Mr. Shobola. I'm trying to get it. So just a few minutes ago. Okay.
Can I say something?
Yes.
So, on the Nigerian tax bill, what has also happened is that for this capital gains to actually be triggered now, if that bill comes into law, means that the disposal proceed has to be above 150 million, and the gain must not be less than 10 million. So what that means is that even if you're above 150 million, but the gain you make on that is less than 10 million, you're not going to be taxable. But the moment you move above 150 million, and then the gain you also make is 10 million and above, you get to fall into that threshold of being taxed of 30% of the profit you make on it.
Okay. Before my questions disappear, I can't find the earlier one, but I think it's connected to this one. This is from Telia Sule to Mr. Shobandre. Question pretty big. You said NGX was putting in place measures to reduce the burden of listing. However, quite a number of firms have delisted. Shouldn't these measures have been in place by now? That's one. I think Mr. Shotubo was trying to ask that all the companies who have delisted, who still have investors, who regulates them, and all of that. So two questions seem to be connected. Yes.
I think I like the tax conversation. I think you can actually do a separate webinar.
Actually, Mr. Falabi Smith has promised to come back for a webinar on tax. So please let's look out for that.
Because the work that's going on in harmonizing the tax laws is huge. It's massive. I think it will have big implications even for the capital markets. But coming into the question of delisting, I think delisting is a challenge that exchanges across the world face, right? Not just in Nigeria. The market is like a cycle, it's like a journey. Companies come, companies go, new companies come. So last year, for example, we had 3 big listings come into the market. Very, very big listings. I expect that trend to continue even this year. Of course, you also find that some other companies will delist. They delist for a number of reasons. One, it's voluntary. They actually choose on their own. Okay, we've come to this point. We would like to go our separate ways. Or sometimes it's regulatory induced. So sometimes they're non-compliant and a number of issues. And one of our sanctions is that we'll actually delist them. So it's a combination of different factors. And the companies will delist for reasons that are known to them, usually commercial or business decisions, maybe from a competitive advantage or whatever, being listed, being transparent, with all the disclosure requirements may not necessarily suit their purpose at a particular time. So they make private decisions to delist. But we do all we can, and with our ecosystem, with the SECs, with the government, we try to encourage companies to remain listed. But it's a free market, so freedom of entry, freedom of exit. We can't force companies to remain. They have to see the value in being listed. Now, the other question, why didn't we do these things earlier?
we continue, the market evolves. We continue to bring in new policies, new rules, but that doesn't stop companies. The companies that want to delist will delist, right? There has to be incentives for them to be listed. I have to say, it's not easy to be a listed company. I have to tell you that the listed companies, and the tax man is here, he can explain, they remit the highest taxes to federal government. So being listed, you become a target,
Responsibility.
right? The highest level of corporate governance, the highest level of transparency disclosure. So the tax man is after you. They just look at you and they naturally. If you are a private company, you don't have that level of visibility, right? Also having visibility is also a good thing. It means that you can also get a wider pool of investors. You can attract capital, local and foreign. So it's really about your journey, what your strategy is, and it's a business strategy. So these things we're doing, as markets evolve, we continue to look at what best practices. Same happens in Nigeria or in London or New York or in South Africa, you will find it's the same cycle. So we must continue to improve our rules to make the listing attractive. We also would like to use the opportunity, perhaps if anybody from the government is listening, to say that there has to be incentives that we're giving to these companies. It's not just that we're taking from them in terms of taxes. There has to be incentives, and I think we've been advocating for this for many, many years. There has to be certain things priorities that are given to companies that have been, because they're actually very well run. And the government needs to give them a lot of support, as we see happen in other countries like in Singapore, in the US, in Europe, for example. They always will give priority to listed companies. These are companies that are adding value, they are creating jobs and all of those types of things. So I think that addresses it, unless there's something that I...
No. You rightly addressed it. One last question for you.
Sure.
But this is quite operational, and I suspect it's from a stockbroking firm, not Meristem. And the person is asking, what is MGX doing to regulate intermember transfer requests? It feels like, from what this person had put here, it feels like CMOs frustrate each other when investors want to move from one stockbroking firm to another. And so he's asking, what is the MGX doing about this?
Very operational question, and I think it's like you already said, it might be a firm or maybe an investor that has been affected.
Maybe.
I think the simple answer to that question, and I'll try to keep it brief, is that the intermember transfer is actually a process that is done when two firms are transferring accounts from one to the other. Those accounts are with the depository, that is CSCS, that's the Central Securities as clearinghouse, as it were. And the process is governed by the CSCS. Now, oftentimes, one firm might want to frustrate that process. Perhaps maybe they don't want to let go of that account, or perhaps they are not clear that the due diligence has been done properly and sometimes it's escalated to the NGX. And in that case, when we see it, we try to intervene by engaging the parties and seeing what the issues are, and work that out. But I think there is a process, well laid out process by the Central CSCS, the timelines. Okay. And I think people need to follow that process, and that should hopefully address the issue. If they are not addressing them, then they can escalate it to us to intervene.
Okay. All right. Thank you. I have one final question for you. We spent over an hour already. Someone is asking, we've heard a lot about crowdfunding, alternative investment platforms in Nigeria. What is SEC doing to ensure that these various forms of investment are safe for retail investors?
Okay, thank you for that question. So investor protection is in the heart of what we do. And speaking to crowdfunding, we released rules on crowdfunding sometime in 2021. So with these rules, we have the requirements for you to be a crowdfunding intermediary. It specifies everything you need, sponsored individuals, capital requirements. And to make it safe for investors, we also enshrined in the rules a threshold of investments that a retail investor can actually put into this crowdfunding intermediary. So as a retail investor, you shouldn't put more than 10% of your annual income into crowdfunding. So it's a way of risk diversification and also helping them to protect their interest in the various investments that they may have. We can also, that's speaking more to the regulation bit. I could also speak to investor education. So we have investor education programs, and we're actually revamping our programs so that we can have more programs like webinars that is more wide-reaching, but we also do the physical ones. We have one-on-one engagements. We also have platform like the CMC where we bring in stakeholders. All these discussions are held there, and we also have policy directions coming from those kind of engagements. So these are all the things we do because we are all about smart regulation. We don't want to be a sit-back regulator. We want to be that regulator who is at the thank you very much, proactive, who is at the forefront of events. And we want to ensure that these crowdfunding platforms are actually safe for people to invest in. So our FINO department is in charge of monitoring this platform, separate from the regular monitoring department that would monitor the capital market operators. So we have the FINO monitoring the crowdfunding intermediaries separately. We just have that delineation so there can be more concentration in that space.
Okay, so I'm hearing a lot of, from all I can hear, there are a lot of innovations going on in the sex space and agents. And one constant feedback I keep saying online is the fact that our regulators need to communicate more. So I think, just the feedback for all of us, that I think that we need to communicate more, talk more about, aside from putting it on our website, we need to find a way to communicate it to the investing public more so that they are aware that we are actually forward thinking of their problems even before they come up with these issues.
I think that's very good feedback.
Yes.
You take that.
Yes. Someone also said that they would prefer if participants are together in a physical location so that they can address you directly as against putting the yes. So maybe regulators need to, as we discussed even before the session had started, look for a way to come together and meet with the investing public to answer some of these pressing needs. Yes. So we've done over an hour. I want to say thank you to everyone for waiting behind. The numbers keep increasing. Thank you, everyone. I am also aware that most of our questions are being answered online. Mr. Stanley Anyaboso, I'm back to you again.
Please go on, I can hear you. I can hear you very well.
Okay, so future directions of the FRCN, what should we look forward to?
A lot of things are going on within the council, and of course, in the financial reporting space and sustainability space. So, as you may all be aware, we have recently, last year, issued the roadmap to adoption of a sustainability disclosure standard. So, and we've seen some entities have early adopted that standard. There are about 4 early adopters of that standard. They have gone on to adopt that standard. Of course, according to the timeline, the roadmap, between now and 2027, there's a voluntary phase where entities are required to adopt this standard voluntarily on their own. But by 2018, the standard will become effective for all entities, all public interest entities in Nigeria. They will be required to adopt the sustainability standard. And of course, in doing that, the council is also supporting reporting entities by doing a lot of advocacies and capacity building. So sometime next week, the council will hold another capacity building for entities within the I think it's the food and the conglomerate sector. We've held these trainings for entities in the financial services sector, entities in the insurance sector. So this training are to bring up their level of appreciation of this standard to be able to adopt the standards effectively. So aside from that, the council is also working on the corporate governance code for the public sector, because we also understand that we need to bring the corporate governance issues to the public sector, just as to get to a comparable level that we have in the private sector. So there is a code that is coming up, and quite recently, the council conducted a stakeholder engagement on that code. So the code is designed in line with the NCCG 2018 is designed to be scalable and flexible. It does not have a fixed, it does not prescribe specific issues to be disclosed. So we believe that code will be important in bringing up the level of corporate governance within the public sector. And of course, the council is also, I don't know, you might be aware that the council has developed a new repository for submission of financial statements. So from going forward, reporting entities are expected to no longer file their financial statements in hard copy. So before now, We receive different versions of financial statements. Some sent to dedicated email addresses, some send hard copies, but we have developed a repository. So through that repository, what reporting entities need to do is just the same way they file their corporate governance disclosures. They just log into the site and upload their financial statements, and the council will receive it. It becomes easy for everybody. It becomes easy for us for our analysis and review. And of course, we also want to expand that portal to also grant limited access to other stakeholders that will be interested in this financial statement, maybe other sister regulatory agencies, okay, other academics, students and scholars and analysts, okay, that may be interested in this data. We'll make it available for them. So these are some of the innovations that have been happening at the Financial Reporting Council. Thank you.
Thank you very much. Thank you very much, Mr. Stanley. I'm back. One last question for SEC. Future directions. What should we be looking forward to in the capital market?
Okay, thank you, Nkechi. So it's quite interesting that we had the ISA signed just recently. I mean, it's been buzzing on the news. There have been blog posts about it, newspapers. We've also had our DG go on TV channels and also speak to the content of the ISA 2025. So that really takes us to what the future of the SEC is going to be like. So the SEC doesn't just want to be that regulator who is just a compliance enforcer. We want to be a market facilitator. So the powers that we have, which have been increased with the SEC, with the ISA, also helps us to be that market facilitator. So we're now able to register and also regulate the cryptocurrency space, digital asset space, which is a budding area everyone is interested in. We are able to look at these things and also bring them to the forefront of the public. So with the ISA, it's giving us more powers to do specific things, expanding the powers of even some of the exchanges. So we can now have the digital exchanges registered, and people are really interested in that. So for us, looking at it futuristically, we're looking at being a regulator who is able to facilitate transactions in the market. I mean, if we want to be that economy that the president wants us to be growing into $1 trillion, then we have to be able to build a capital market to be able to finance those transactions and facilitate those transactions. So that's the direction the SEC is looking at.
Thank you very much. Mr. Shivani, one last word for us. Future directions for the NGX. What should we be looking forward to?
I think we'll take a cue from the SEC with the new Investment and Securities Act. Digital transformation is really the future of where we see ourselves. So we will see a lot of innovation, a lot of new products coming out. We would like to engage with the retail investor base. We would like to see a more active youth segment of the market. We would like to deepen the market even with listed companies. We would like to see more listings come in. We would like to see the big national companies, the NMPCs of this world. And we're very excited with some of the changes that we've seen very recently and some of the talk about IPOs and all of that. There are a couple of other big companies, the LLNG and the Dangote refineries, and these real big African giants. I think that we would like to see the NGX and indeed the capital market in Nigeria play a more prominent role as far as the Nigerian economy. Right now, we're only a fraction of what the national GDP is. If you go to countries like South Africa and some of the other large economies, their exchanges, the market cap is multiples of the GDP. And so we have a long way to go in terms of growing and deepening that market. And I think that the ISA really gives us that foundation that we can really push on. But really the future is digital. And I think that everyone now has access to smart devices, whether it's phones or otherwise. And I think that using these devices, whether it's to access markets, whether it's to trade or whatever, we want to bring the market closer to everyone, to you and I, and to everybody else involved. And to the companies that are out there raising capital, they should be able to do it in a more seamless way, in a quicker way, at a cheaper way as well. And so there's a lot of opportunity that we see ourselves playing in. But essentially the future for us will be digital, and I believe that we would hopefully grow the Nigerian economy towards the aspirations of the president.
Thank you, Mr. Shubanjo. Any last word for us, Mr. Fernandez?
Okay, so for me, quite a lot of things have been addressed. But then again, the future of taxation, I think federal government is looking more inward. We are gradually leaving that era where we were all dependent and looking for other avenues. I think the new cash cow is taxation. So everyone has to sit down tight. And it is not enough to sit within the coffers of your environment and then make certain decisions. Ask questions. Talk to your regulators. Seek guidance from tax professionals. Because some of these investment decisions, what we've seen in practice, is that a lot of times people would have made these huge investment decisions based on hearsay or without, a robust advice. And then when they've landed into it, they're then looking for, how do I wriggle out of this? So people will now have to seek professional guidance so that your funds are protected, and then you're not being exposed to, taxes as much as, you would have if you did it by yourself, And again, like Mr. Shubandi said, the digital asset, the market is expanding. It's going to blow up in the next couple of years. As far back as 2012, I know the capitalization base was around 7 trillion. Right now, as at October last year, it's like 106 trillion. That shows that the growth is massive. Whether you have a tax exemption or not, people are also being compensated by way of return on investment, and everyone just wants to participate. The digital assets the digital nature keeps evolving. And with the way we're projecting into the future, that's going to be like the new cash cow, because a lot of businesses are, transcending into having digital asset and creating a large base on that. So I will just stop at that. Thank you.
Thank you very much. I would like to say thank you again to our guest speaker and our esteemed panelists for gracing this webinar. Please note, if you still have questions, please send your questions to info@meristemregistrars.com or contact@meristemng.com. We would also put that in the chat box. And please do look forward to our next webinar. As I mentioned earlier, Mr. Folabi Smith has been gracious enough to volunteer to come back again and have a webinar to address all your tax-related issues. And then maybe hopefully we will have someone from the FIRS also here too. But there's a particular question, Jenny keeps saying FIRS, and I'm like, Mr. Folabi does not work for FIRS. So I couldn't even ask you. But this person has been repeating that question over and over again. So we do need a webinar to address tax-related issues. Thank you, everyone. We are glad you joined us on this. Thank you so much. Thank you.
When it comes to making great investment decisions, everyone needs a buddy. Now you have one. Introducing Wealth Buddy, the go-to app where you can save, invest, and pay your bills. Now you have a buddy to help you reach your money goals, uncover attractive investment opportunities, and make payments with the press of a button. Here's how it works. Saving on the Wealth Buddy app is super easy. First, ensure you are logged into the app on your mobile device. Then head over to your savings dashboard. Click on the plus sign to see a list of savings options to choose from. Add your goal details and start date. You can also add a photo to personalize your goal. Choose to fund your savings plan from your debit card, and then you're all set. There are several options to choose from when you invest with the Wealth Buddy app. Head over to the investment dashboard. Click on the Add Investment button. Select on the Create Investment option. Choose an investment option from the list. Read all the information, then click Invest at the bottom. Fill in the required information. You can also add a photo to personalize your investment. Choose to fund your savings from your debit card or your wallet, and then you're all set. You can also pay your bills conveniently directly from the Wealth Buddy app. Go to the wallet dashboard and select one of the bill's payment options. Pick a bill you want to pay from the drop-down. Fill the relevant details and choose to pay with either your debit card or your wallet. And just like that, you're all set. Start your journey with your new buddy. Download the Wealth Buddy app on all iOS and Android devices today.
When your name couldn't open doors, you didn't give up. You made your way in anyway, only to find out that there are many doors you still need to open. So you work hard to get the keys until your name began to open doors.
Let Meristem help you keep the doors open for generations to come. Meristem, let's grow wealth for you.